Andrew for the introduction. So as Andrew said, I'm Louise Clark. I am a transactions partner at EY covering all aspects of real estate. So welcome today to our deals panel. It feels like there's been a bit of an uptick in transactions over the last few months, and with talk of big processes in student and hospitality launching in a few months, it feels like a more exciting time to be talking about deals potentially than a year ago. But having said that, there are certainly still some challenges in the environment. And today we are going to try and address the following three questions, which are: when will deal activity return to normal pre-COVID levels? Are you still seeing gaps in the bid-ask spread, and what do you think will be needed to correct asset prices? And finally, will bank debt regain its place as the largest source of financing for real estate transactions in Europe? So with that in mind, I'll pass over to my lovely panel to introduce themselves. So Louise, do you want to go first?
Hello, I'm Louise Burney. I am the operational real estate asset lead at Legal and General Investment Management, and I'm also a senior asset manager focusing on alternatives and operational real estate.
Good morning, everyone. My name is Shona Pushpaharan. I am the head of hotels, healthcare and landed estates at Coutts & Co, and we are senior debt providers.
Hi there, I'm John Lee Jones. I'm the Senior VP of Investments at Lifestyle Hospitality Capital, and I oversee our European investment activity.
Thank you. And unfortunately, we don't have Peter with us today. He was impacted by the trains, but I think we've got more than enough expertise to cover off these topics. So with that in mind, John, shall I hand over to you on question one, which was, are you seeing an uptick in deal activity, and when do you think that deal activity will return to normal levels?
Well, I guess the first question I have to answer yes, because our team has been one of the one of the reasons for the uptick in activity over the past 12 months. But I think we do have to kind of reorientate that a little bit. I think we're all trying to see, will we return to pre-COVID levels? But we're in a very different environment right now. Pre-COVID, we were in a free money environment. You could make deals work at levels and at pricing based on, very low levels of debt financing and low levels of cost of debt. Whereas now, at least definitely now, and looking into the short to medium term, that's going to be a very different situation. However, having said that, I think there has definitely been an uptick in activity, but it's driven by some very specific situations and very specific scenarios. I think in my head, I kind of group them into kind of four categories at the moment, at least in the immediate term. One is not full distress, but I think it's almost semi-distress, where you have a lot of owners, a lot of investors that have had capital structures that were somewhat unsustainable, so they're looking to restructure that now, try and find a mix that works best for them, or in certain situations look to exit totally. I think that has driven some activity. Kind of linked to that is equity shortfalls. So speaking purely from a hotel perspective, some brands now, after a bit of a hiatus, sort of immediately post-COVID, they're looking to, drive property improvement plans in collaboration with their owners. Some of these owners don't have enough cash to execute on that. And then there's also some that, just purely from refinancing, the debt levels, and we'll get into that in more detail later in the talk, but the debt levels are not quite at the level as they were pre-COVID. So there is a bit of an equity shortfall gap that is also causing some, creating some situations for deals to happen. Then there's the office valuation side of things as well, which is the second group. I know a lot of hoteliers, a lot of hotel investors are looking at that as an opportunity right now, where we can create value versus other change of use opportunities. That has driven quite a significant amount of activity, especially in London, which is obviously where we're based right now. There's been a lot of large portfolios that have come to the market and seem to have transacted. There was one that just completed the other day. I think that's an opportunity for a lot of investors that have a lot of dry capital or dry powder to kind of start either continuing their thematic investing, acquire platforms, use this opportunity now where there is still a little bit of dislocation, where they can efficiently deploy their capital, but do so in a way that makes sense in their wider strategy. And then there's this fourth bucket, which a couple of individual assets have kind of driven this, where I think either high net worth, family offices, and even to a degree, some vehicles that are funded by sovereign wealth funds, where they just have a generally lower cost of capital, a longer outlook in terms of their real estate strategy. They're looking at this now as an opportunity where some of the more aggressive investors are a little bit on the sideline. They're looking at this as an opportunity to pay a little bit more, but secure real estate that is prime, that over a 20, 30-year time horizon will retain and definitely improve, increase in value. So I think from that perspective, it's a definite increase, but it's not like a pre-COVID situation where everybody had an opportunity. Their financial engineering was driving a lot of the ability to do so.
Yeah.
Now it's about, I think, being very strategic, being very specific about how you're creating value in new opportunities, and I think that's given you that ability to complete deals.
Thanks, John.
Yeah.
That's great summary. And
Yeah.
Shona, is that consistent with what you're seeing from a lending perspective?
Yeah, I think, look, we know bankers love a worst case scenario, but I'm generally very optimistic. I mean, I was looking at the stats here the other day for just the number of transactions that have gone through, and in Q1 in the hotel space we've had over 2 billion, driven largely by portfolios. That just wasn't present 12 months ago. It's made a big difference. We're seeing as well, look, I cover hotels and health, we're seeing a couple of our clients who've spent time in a more fragmented market in some ways in healthcare, building up a portfolio by either individual acquisitions or by building themselves, developing. And now we're seeing institutional capital come in. Now they're successful, they're up and running. We are seeing that institutional capital coming in and paying a decent price. We'll come on to that, the gap between the two in the next question. But so I remain very optimistic about that. From a senior debt perspective, what are we seeing? What are we seeing deals? We aren't seeing a lot of acquisition. We're in the senior debt space. So we're only up really to sort of 75 to 100 million. We aren't seeing the acquisitions and we aren't seeing the development in quite the same way, but we are starting to see a lot of the refinance activity, which actually is often a forerunner to other activity, because that means there's confidence in the market, there's confidence in the banking sector, we're lending, there's a view on long-term rates. So we are seeing a bit of an uptick. And then just in terms of what John said about, we focus obviously at Coutts & Co on high net worth individuals. So often we are lending to a group of individuals who have a very different IRR perspective. They're not driven by, I need an IRR of 17, 20, 25%, whatever it may be, within 5 years, 3 years. This is, as you said, it's long-term, multi-generational, and they'll take a hit for 2 or 3 years, take a view on an asset, just to get that long-term capital growth, because it's not just for their children, it's for their children's children's children that they're buying. So that's where we've seen some of the activity, I think. But I remain positive, as always, and we'd like to lend more.
That is
always.
very positive. So with that in mind, Louise, should we talk about the kind of pricing aspect and the difference between sellers' expectations and buyers? Are you still seeing a gap there? And, what do you think needs to happen to close that gap if it's still there?
Yeah, absolutely. I think everyone talks about this spread, and I think there are variances depending on the individual sectors that you look in within operational. I think, for example, hotels, I think there is quite a large spread in a lot of instances. Perhaps not at the core end. I think it's more at the value add, and that's really been driven, I think, over the last couple of years by, the strong trading fundamentals, but the investment market perhaps hasn't really reflected that. We've seen movement in yields across all the commercial sectors, and even kind of the student and the residential, which were obviously demonstrating much sharper yields. I think where the challenge is and where that bid spread still exists is because there is always historically been a differential between your kind of core operational, so in terms of the BTR, the PBSA yields, showing that yield differential in terms of the risk profile versus the hotel sector. And I think that hotel sector yield perhaps hasn't, vendors' expectations hasn't moved out as much as it may need to. I think in terms of kind of how we're going to reduce that. I think there's a couple of elements. I think there's an element of we need more kind of debt coming in, fresh capital coming into the market. Us as institutional investors are very much active in looking for core opportunities, but I think the challenge is there aren't that many. There isn't a need to sell at the moment for a lot of people, and I think that's really key. And also, I suppose there isn't that urgency to buy. There is a lot of capital, and everyone talks about capital being there and being ready to be deployed, but people are more hesitant. They are doing a lot more due diligence. They're being very picky on the assets, us included, in terms of what we're looking for, because if we are going to deploy that capital into a sector that hasn't seen many transactions, we want to make sure we're deploying that into an asset that fits a lot of our criteria. I think just linking back to the first question, I think the other 2 points, just in terms of deal activity and how that's going to drive, I suppose, reducing that spread, is that I think there's an element of institutional capital coming into these operational sectors, and we've talked about that in the previous panel about institutional capital coming in and getting more of an understanding and taking on that risk profile. But I suppose the challenge is they're generally longer term holders, and so you're not going to get the same recycling of assets over a 5-7 year period that you would when you've got private equity. So I think there's an element of there will be, there's been assets that have been held perhaps longer than existing business plans. So I do think over the next 18, 24 months, we will see assets come to the market. But I think going forward, where that deal volume, what is that new norm? It'll be interesting to see, because I do think there's an element of we need new, fresh stock to come through to be able to almost replace the stock that institutional capital is going to invest in and hold it for a longer period of time.
I think there's also, though, isn't there, we've certainly seen that some of our clients, there's, and they talked about this again, what's happening in office has a profound effect on the other real estate linked sectors. We're seeing a change in a number of office assets coming up, and our hotel clients, if they're in a great location, are, I think, are really gunning to get those assets. And actually now you're seeing on some assets, you're seeing a competition, whereas maybe you didn't once upon a time from different real estate linked sectors. Once upon a time, that would have just been the preserve of office. And now you've got hotel people, core real estate, student, all sorts, resi, all looking as well at assets. So the pool is sort of widened a little bit as well.
I'll just kind of touch specifically on that bid-ask spread. I think it is narrowing, but it's not quite yet at the levels that is going to enable a plethora of deals to get done. But just looking forward a bit, and this will probably tie into your last question as well. There's a lot less uncertainty looking forward, and for all investors, having a little bit more certainty in the forward-looking debt curves helps a lot, because then you can underwrite a lot with a lot more confidence. You can go to your credit committee with a lot more confidence, and then combining with what Louise mentioned in terms of the trading performance. It's going to be interesting to see what comes out of, I guess, a full year 2024 trading. We've had 2 years now, especially on the hospitality side in markets and with assets that are, strongly supported by leisure demand. I think we're starting to see a little bit of, that stabilizing out, depending on certain
Q1
markets.
was a bit tougher, wasn't it, this year?
Yeah. So I think coming out of this summer, going into the rest of the year, to kind of have that, backward-looking view, I think we're going to see that this is my perspective, I think we're going to see that stabilizing out. I think that will then help bring seller expectations down a little bit more, combined with a little bit more certainty in terms of being able to underwrite your cost of debt on the buyer side. I think that's going to start bringing things together. And you do kind of see that now already. And, there have been a lot of fully marketed processes out there. You start at this level, investors don't buy it. 2 months later, they come back to you and say, okay, well, actually, look, this is what's going on. Slightly kind of broken process. So I think it's the reality starting to hit in on both sides of the deal. So I think it's just going to take a little bit more time, maybe a slight hit, as I said, to trading, to then bring it even more close together, and then we can start seeing a bit more fluid activity.
So let's touch on the debt point then quickly, because it's come up a few times. But Shona, what do you think? Do you think that bank debt will regain its place as the largest source of debt?
As far as I'm concerned, Louise, it's the only source.
Yes.
So, look, I do. I've already touched on the fact that we're seeing a lot more activity in the market. I think that not everybody has come back from a banking perspective. I think that there are some specialist and key lenders. Certainly, look, I speak for the senior debt market. There's been some of those have come back in and been very consistent actually through COVID. Some have. Where are we seeing the opportunity, and where would I like us to do more? Well, we'd love to do more in the development space. You know, I think banks have a reputation for being very cautious in that space. Actually, you know, we're not. There's a number who will move into that 65% loan to cost. You know, obviously we're operational real estate, so we're never just cost led. We're always looking at the back end leverage point on a stabilised basis. So I think that there's a lot of opportunity there. There's more people coming back into the market. Some banks who have been sitting on their haunches waiting, some banks who've decided to reduce their hold levels in a number of cases, and we're now starting to see them come back in. Certainly in the space I'm in, we would have seen pre-COVID quite a lot from the debt funds. We don't really see them a great deal. I know they're a bit more active sometimes at the higher level, and when we've talked before, you said they're the ones that you guys are seeing at the investment management level, but we're not seeing that. What do I think banks need to be? A bit braver. You know, we could all be a bit braver. There's a bit more certainty in the market in terms of, you know, a lot of the cost challenge. You know, there still is cost challenge, but there's been a levelling out and a settling, as John said, in the market. So we've a little more certainty. Who knows where interest rates will go, but we hope that we'll get a little bit of a release and relief shortly on that. But the 5-year swap curve has come in. So there's a lot to do. Do we want to lend more? Absolutely. We'd love to do more, you know. We'd love to lend more, and I think there's a number of banks, but there's not the transactions as well.
Thanks, Shane.
So
Keen to get some audience questions in as well. I think we've got just under 5 minutes left, so open it up to the floor.
Hello, Amanda Nurse Carterwood. If I was to give you each personally 200 million, where would you invest it?
Louise, do you want to take that?
Okay. To be honest with you, I think I'd probably look at a couple of different sectors, and it's really about, I suppose, balancing kind of the demand supply, the demographic need. So I think there's an element into residential, and whether that be single family, multifamily, kind of urban, suburban. But I definitely think that's, you know, we touched on the last panel in terms of the demographics and the need-based demand there. But I also think, you know, I think there would be an element into hospitality. I think there's a really interesting opportunity over the next 12 months to identify opportunities in certain subsectors and certain regions. But I think it's very specific into individual component parts of the hospitality sector and where that might be. And I think another interesting opportunity, which I know as an investor we're looking at, is into an element of the care, and that's a big sector to cover. But if you look at the demographics of the population, there is a large cohort that us as investors don't currently have a huge amount of assets in. So I think that's an area where we'll be looking into that.
And perhaps in a couple of words, any other views there?
Well, I don't really invest, so I lend, but I think it depends whether it's short term or long term. But for long term, I'd stick with my two favourite, which is hotels, and I'd stick probably London for long term growth, and I'd also go into the social care sector.
I mean, we're a very specific investor, and I think you should provide 200 million to us specifically for lifestyle, hospitality-focused investing. But I mean, I say that kind of in jest, but I mean, we do have very strong conviction about, you know, if you look at the macro trends of consumer demands, kind of within hotels at least, where the industry is going in terms of catering to those demands. I think lifestyle hospitality is definitely where I'd, you know, allocate a quite significant amount of that, you know, funding. And then markets-wise, yeah, it would still be the kind of key main prime diverse markets across Europe, you know, the time. Yeah, so I'll leave it
Any
there.
other one? I think we've got time for one more quick question.
Thanks. Christian Mole, EY. I think it was mentioned earlier by one of the panel that you were seeing on some of the deals we're going through, but there's a high level of diligence being done. I just wondered what's driving that and what particular areas you're seeing the additional diligence being done in.
John, was that the case on your last transaction?
I guess it depends on the situation. I think, yes, to a degree, I think there's a few factors to that one, right? When I was kind of outlining the kind of groups of types of opportunities that have come along, if there is a semi-distressed situation, which is not full distress, but semi-distress, a lot of those owners would be looking to, be very careful about where they spent their cash. So that could have an impact on, the physical aspects of the building. So from a technical DD side of things, you do focus on that a lot more. I think, anyone with a capital partner, you want an institutional quality capital partner. Technical DD is important and is a focus. And then similarly, kind of following that logic, if existing owners are restricting the use of cash, you do want to be a bit more robust in terms of your financial DD or your tax DD. So I think just by nature of what we've come out of and certain decisions that certain owners and operators need to make, that by default will make you kind of dig into certain things a lot more. So yeah.
Shall I just very quickly answer that from a lending perspective? I think that post-COVID there was an awful lot of due diligence, and we love information of feasibility. Of course we do. I think because of the settling, we're not purely forecast-led anymore. We've got a year of data, of good data, particularly in the hotel market, that gives everyone an element of comfort. So I think you'll see a little bit of an easing back, potentially, on that. But we still like a feesy.
Thanks, Shona. I'll ask one very quick final question, which is how many more months do you think it will be before we stop asking when will deal volumes return to normal?
I'm going to say about 18 months.
Okay.
I'd like to say 9 months.
Okay.
I have the same answer, 9 months as well.
Okay, well, let's hope it's 9, not 18. But thank you, everyone.